2017 has been a significant year for Indian real estate. Some say it will go down as a historic year, with residential sales in new launches plummeting to a new low in the aftermath of demonetization and implementation of RERA. But curiously, 2017 has also been the best year for PE investments in the real estate sector. It's only curious till you decode the data. The slowdown is in residential and the PE investments look swell because of office space. Welcome to Urban Reality Special, where we understand what drove investors' money in Indian real estate in the year gone by and what's up for 2018. Here are the three big questions we'll be seeking answers to. Did 2017 bring in new PE investors and new confidence in the Indian real estate market with regulatory changes? Or was it the same bunch of investors? Number two, we know the bumper numbers came from investments in office space. But are PE investors biting enough into India's residential real estate? And at what cost? Because this is a sector which needs the oxygen. And finally, why did 2017 turn out to be such a damn squib for REITs? We were hoping for at least one listing. And will 2018 be right for it? Joining me to discuss all of this, Anshul Jain, Country Head and Managing Director, Cushman & Wakefield, India. Sharad Mittal, Director and Head, Motilal Oswal Real Estate Fund. Balaji Raghavan, CIO, IIFL Asset Management Limited. And Neeraj Bansal, Partner and Head of Real Estate, KPMG. And of course, their report is one that we will be using through the discussion as well. Renewed confidence, but if you keep the DLF deal aside and assess the inflows, because that one single deal makes the figures look really fantastic, how would you rate 2017 for PE inflows? Neeraj, the question is for you.
So PE inflows, as you rightly said in the initial conversation, that commercial office assets are the one which have been really most attractive for the investors in this space. Residential segment, while we see a drop in the residential segment in that, but I think structured debt is still kind of coming in there. And with the fact that you had so much of a hit coming up with demonetization and a lot of uncertainty which had come up because of RERA. RERA, while it's a very strong and positive step in the direction, but it led to a lot of uncertainty with changing rules by different states and different interpretation around it, and the fact that you couldn't have project launches happening around it, which in the short term there is a lot of pain on that, but in the medium to long term, I think that's a very positive in that, because what we see right now is that in our conversation with the investors in the overseas side of it, whether look at the South Asia region or in the Middle East side of it, we see a fair amount of interest coming up to say that the Indian real estate was facing a lot of trust issue that will get resolved through the transparency created through RERA mechanism, and also the fact that with the slowdown on the launches side of it, the inventory will get covered up in that. So residential sector in some ways, and I think 2018 and 19 will see much more better offtake on real estate side there.
All right, so you're believing that 2018 will be better for residential as well, but I'm just looking at some of the figures from your report, and of course this is an October report. We still don't have the latest numbers. They will come in the new year in January, but the pie is very interesting. You keep clubbing commercial and office space, and you hear about the mega deals in office space, but maximum money actually went into retail, $1.6 billion, and of course office space got 1.4, warehouse got 1.1, that's the new sector, and residential got just a tiny little piece of $0.6 in billion, of course. Anshul Jain, decode these numbers for us. I mean, renewed confidence we speak about, but did new investors come in 2018, or was it the same old, same old?
It was primarily the same old investors, but with more confidence. So the amount of money that we've seen getting poured in, or the intention of money coming in, is significantly high. I think this year, 2017, as the December numbers come in, we'll probably see a 15 to 20% uptick in the private equity investment year on year from 2016.
Minus the DLF deal, because that itself
minus the
is
DLF
a
deal.
large
Minus the DLF deal. I'm not talking about DLF.
Makes the numbers look bumper. Okay.
Minus
so
the DLF.
Minus DLF, 2017 should be about 15 to 20% above 2016.
Correct. Okay. Warehousing was obviously a big sort of year for warehousing. If you look at 2016 numbers, it was probably in low millions, maybe $100 million or something like that. It went from that amount to almost $1 billion. And what's very important is we've seen now 4 or 5 major players who've come in warehousing. And in the next year or two, we are already seeing a massive momentum into it, and we'll probably see a huge uptick from where we are in 2017.
From warehousing itself?
From warehousing itself.
Okay, what happened to retail? How did retail suddenly emerge as one of the big ones?
See, retail has been on the revival for last year and a half. So general prediction for the Indian markets is that, the consumerism is going to rise, the incomes are getting healthier and so on and so forth. The same story. But you see all the major retailers coming in, right? So if you talk to sort of all the mid-levels, let's say fashion brands, right? Marks & Spencer, H&M, Zara.
Everyone wants to bite into the India
Yeah,
pie.
and everybody's plan now is from 20 stores this year to 30, 40 stores next year, right? So clearly there's a big sort of momentum in expansion. And of course, the private equity players are tracking that. And it's a great time to just kind of get the malls under the belt at reasonable valuation, because once you've seen the demand uptick kind of going, suddenly the valuations will go up.
All right. So reasonable valuations is the other story we heard through the year. That was a theme that, developers in office space, commercial, retail, were all on the table talking a reasonable number, unlike before, where conversations, of course, were very different between a PE investor and what the developer really valued his asset as. Balaji, would you agree that probably 2017 would be marked by some sanity returning to the market in terms of valuations?
Yeah, absolutely. I think across the sector, across various asset classes, we have seen that sanity has returned, and that is very obviously because of, I think, all the vectors. As in, if you look at why it has come into place, is that the consumer on one side obviously has a certain value for the asset itself, which is the end user. And secondly, of course, the investor, having gone through the cycle of debates, negotiation with the developer, and the developer realizing that money is not so easily available, capital is not that easily available, and therefore the valuations have to be sensible. So I think that is something which has finally dawned upon the developer also. So I think this trend will continue, and this is what I guess will also be a driving force behind the revival that we are talking about in the coming couple of years.
All right, so we talk about revival in the next couple of years. Sharad Mittal, now let's move to residential PE, where probably the maximum gasp for breath or for any currency to keep that market going. Sum up 2017 for us. We talked about RERA, we talked about regulatory changes, demonetization, the worst affected sector. But for PE investors like you, it was probably the best exits. How did that play out?
See, actually, just to bring this point that we are looking at 2017 as a year in which the money to the residential sector is low compared to the other asset classes. But we need to look at it in the perspective of what kind of eventful year we had. We had, in 1 year, we were packed with all the disruptions which could take place. But let me add here that when we speak to offshore investors, also to the domestic investor, we see a great interest to put money into alternate assets, which eventually will invest into residential properties. On the other side, there is no quick solution to the residential market. It is going through a challenging phase for last 4.5, 5 years. But last 2 years, if you dig deeper into the data, the launches have reduced. And both in 2016 and 17, the absorption numbers are more than the fresh supply. So over a period of next 12 to 24 months, the demand supply will get adjusted. Also, the regulation would do its part. So somebody who forms a view of 3 to 5 years, and we investors like us wouldn't form a much longer view than that, residential would come back stronger. It's just a patience game. The consolidation is taking place. You need to be with the right set of developers. You can't make quick money, quick buck in next 1 or 2 years. But from a view of 5 years, there is a lot of fair bit of money to be made.
Balaji, is that what you're hearing from your investors as well? Because, there was a report of private wealth money and where it's going, and it seems that actually a lot more money has flown in 2017 into real estate funds and investments. What are you hearing from your investors? You've launched a new fund.
No, absolutely. So because I think what has happened is that there is always a maturity cycle with any segment, whether it's the investors or the manufacturers. So investor earlier on, let's say about a decade back, who used to do direct investments in real estate, whether it was buying an apartment or a commercial unit, or whether it was lending or investing directly with a developer, I think they have realized that a professional management is necessary in order to ensure that their returns are secured. So therefore, a lot of that wealth has been flowing and getting rechannelized into funds such as ours, and whether it's Sharad's and so on. So that is the trend which has been happening, which is why we have been able to raise so much of capital towards this sector.
What kind of yields, Sharad, this question is for you. What kind of yields are you promising your investors? Because if you're saying that, give us patient capital, patient money, and you're saying investors are looking positively at the Indian residential story, what sort of yields are they going to be better than what you've been able to give them in the past?
No, actually, if you really see the interest rates over a period of last 4 years have come off by anything between 100 to 150 basis point, and for real estate it's translating at the higher end of the cost, it is translating anything between 300 to 500 basis point. The point that has to be made here is that as the industry is getting consolidated, the opportunity is to put mezzanine or a structured equity money behind consolidation opportunity. For us, when we look at a mezzanine or a structured equity, we don't do pure debt transactions. In fact, we have never done pure debt transactions over a period of last 5 years. I think early 20 kinds of gross yield is something which is a mix of structured equity and mezz will be a fair representation to make.
Okay, what was the color of the money, Neeraj? I mean, you are in touch with developers, so is it getting harder? The other PE investors driving a harder deal? I'm not going to ask either of the investors this question, but what do you hear internally?
No, sure. So I think clearly the developers are in a scout for lot of challenges around it for themselves, because they've got a lot of pressure on the regulatory side, and so a lot of payments to get done. The buyers are not making a lot of payments around it, so delays in construction are causing them a lot of grief in that sense, and that is what is kind of driving them to source this liquidity from the private equity or other investors in that, and that's kind of putting together in some way more sweeter deals from a PE perspective, and also from a land sale point of view as well. We have seen that some of the transactions where we in terms of some of the things which are offered in 2015, 16, 2017 has been quite a difficult year, and some of the deals are fructified because of the immense challenge that some of the developers are going through in that. And I think another way to look at the residential sector, while we were discussing it in the earlier section, in that would be also to see that we have to slice it from the point of view of the affordable housing, the student housing, the staff housing, also looking at it from a senior living perspective in that, because generally we kind of end up with the premium and the ultra luxury housing much more there. But now we've started to see more stronger talks and stronger discussions, as well as more proper channelization of funds towards the affordable housing, slowly kind of coming in there in that.
All right. Okay, so that's good to know. In fact, I was going to ask that question. Is the money moving into new directions? Definitely, if affordable housing is the theme, that's where investors are also finding more value. Okay, we're going to come back and continue with that conversation. What about the developer panorama? How many developers are worth really putting your money behind? As PE investors have to answer that question. And also 2017, which turned out to be quite a damn squib for REITs. Will 2018 see some of them finally take off?